Welcome, everyone, to another installment of Coffee with Carl. Today, we're going to be focusing on the life insurance space. I have Ben Basile here from Crump Life Insurance Services. Ben's been a long-time partner of mine. We've worked together for many years on really just being able to provide a comprehensive insurance solution to a lot of our clients. So, wanted to bring in Ben today to talk a little bit about life insurance. Welcome, Ben.
Thank you. Nice to be here.
Yeah. Well, let's get it started. One of the first questions I often get is, why do people need life insurance? And it can vary, I know, from different types of families, but, what are some of the main reasons that you see when you're working with, a lot of the families out there?
Well, there's definitely a lot of reasons why people, would want to consider life insurance, but let's get to the guiding principle of life insurance, and that's recognizing the human life value and possibly being indemnified if there was a loss to that life. Insurance helps make families whole. It make sure that mortgages are paid, children go to college, incomes are replaced, spouses' retirements, remain on track. And lastly, to be able to leave a legacy, for generation two and hopefully generation three.
Now, when you're going through that process, how do you determine, what type of insurance to buy? I mean, a lot of times I
Mhm.
have questions around, term, permanent.
Mhm.
Would you mind just
Sure.
walking through some of the different types of insurance that are out there?
Sure. To try to simplify this down a little bit, there's generally two fundamental camps or two different types of life insurance. There's term insurance and then there's permanent insurance. And the easiest way to look at this is really the difference when you're looking at real estate. There's renting and then there's owning. So you can rent an apartment and it comes with maybe a lease agreement. So you have a fixed price for maybe a year, maybe 5 years, and it's locked in. But when that term expires or that lease expires, the rent will go up. It gives you a place to live. It's low cost, but there's not a lot of commitment. There's not a lot of equity or long-term equity or choices. Um, Owning, obviously, costs more initially, and it gives you choices later down the road. The costs remain fixed, so eventually it gets more and more, or less costly. And over time, it could actually get paid off when you own a house. So permanent insurance and term insurance work in the same exact way. One is owning and one is renting. Now, when you talk about permanent insurance, then we get into a couple of subcategories. So there are four fundamental types of permanent life insurance. There's universal life insurance, there's indexed universal life insurance, there's variable universal life insurance, which is using mutual funds, and there's whole life insurance, which is basically a company that's a mutual company offering a dividend. Um, the permanent insurance options, again, let's go back to the housing, right? The housing situation. When you're buying something, when you want to build some equity, you don't have to just buy a house. You could buy a condo, you could buy a co-op, you could buy into a townhouse. So the different permanent options, they have different bells and whistles or different optionality features, based on what suits the client the best, and what type of risk tolerance they have and what their goals are. So those are really the categories.
Maybe it might be helpful too. One of the things I find is a lot of folks are just kind of pushed into one camp or the other. Hey,
Mhm.
either by term because that's the type of advisor they're working with, or it's either by permanent. Do you see
Mhm.
a lot of folks out there maybe blending, some term insurance, some permanent, and to create a more custom solution?
Absolutely. What I like to kind of explain to people is, the life cycle or the need for insurance. And when you talk about the need for insurance, it kind of works like a meter, right? So when you're born, the need for life insurance or your human life value, what you bring to the table is very low or insignificant. But as you get older, maybe you start having some expenses, maybe you have some shared expenses, maybe you end up getting married, you have two kids, you've got a mortgage, you've got college education, and your need for insurance is now screaming, like a meter. Then your first kid's done with college, second is done, mortgage gets paid. And then what we see is you kind of stall out down here, and people then want insurance for some of the ancillary things or some of the other things that life insurance can do for you. Now, to answer your question, well, how do you fill that need? And typically what we're doing is blending insurance, together. We're using some term insurance, or a good amount, a fair amount of term insurance to fill this high meter need, because term is more cost effective, doesn't cost you as much, and you may not need it forever. So we'll take a block or a couple of blocks of term insurance to fill this section of the meter. And then what we'll do is we'll backfill, with this area down here, we'll backfill with some kind of permanent insurance that will remain in force for the rest of your life, and you can be used for other things.
Yeah, I think one example of that maybe is if you have, two children that are, 10 years from when they would be graduating college, for example, and then maybe have a newborn. You could look at something to the extent of maybe a 10-year term, and then you have a 20 or a 30-year term,
Mhm.
layered on top of that.
Yep. Sometimes people marry them up to, the mortgages or their debts. If they're, looking at college mortgages and a couple of things, they kind of have some trajectory of when these things are going to be paid off, and they can ladder in term insurance to meet those needs or keep up with those needs.
Could you walk us through? I know you hinted at a couple of the different types of permanent insurance. Are there any, reasons that hey, one, maybe somebody in their 20s or 30s, and again, this is just broad strokes, might
Hmm.
look at like whole life insurance or variable, or
Hmm.
somebody in their 50s or 60s may have a, maybe leaning into other types of insurance. Could you walk through just if there's
Sure.
any things that you typically see,
Sure.
across the industry?
Well, one of the reasons people will make a selection of one versus another is might be based off of a risk tolerance or their investment style, right? So if you look at their investment style, and they like CDs at the bank, and they take really conservative mutual funds in their 401k, and they're not into the ups and downs of the market, not really comfortable with that, we might gravitate more towards a whole life strategy, which is a little bit more of a slow and steady wins the race kind of approach. The whole life insurance is, again, provided by a mutually owned company, and mutual companies offer dividends at the end of the year if they're profitable to all their shareholders and policyholders. So you're typically looking at right now around a 5 to 6% rate of return on a dividend annually, but you're not going to see radical fluctuations. Then you might have the polar opposite of that individual. Maybe they're very comfortable with the market and the market fluctuations. They invest in a 401k. Maybe they have a TD account on their own and they do a little bit of trading. They're looking for maximum growth potential. They understand that any given year could be a negative year in the market, but over time, staying in the market will yield them the best results, and they're comfortable with that strategy. Then we tend to go more towards a VUL, variable universal life insurance. Then what the market, the insurance market came up with was a product that kind of fits squarely in between those. Maybe you're not completely conservative, and maybe you're not an aggressive person, but maybe you want something in the middle, right? So you want to see some of that market growth. You want to be able to gain some of that market upside when the market's doing well, but you also want to protect yourself from radical drops or radical shifts in the market. Then an indexed universal life insurance contract might be the approach for you. Indexing works quite simply by taking what we call a cap and a floor, and they'll put a cap of, let's say, 10 and a floor of 0. And it's kind of like a training wheel or a cap or collars. So when the market does well, you can receive up to 10% returns. And if it goes any higher, you're capped. And in the market will protect you from anything below a 0. So the worst you can do is a 0. So if you take the 10 and the 0 and you kind of average that out over time, you should be seeing something around a 5 to 6% rate of return, maybe a little bit better. So that's quite a popular strategy for many investors that don't want to have to monitor things too much, and they just want to see some quality returns over time. The last one is really like a universal life insurance. It's a little bit more conservative in its approach. It's based off of the interest rate an insurance company is willing to declare. Those are stock companies. So if it's a stock insurance company, they'll give you an interest rate every year. So what we'll see happening is, as the younger investors, they're typically going to go more towards the VUL and IUL strategy because of the long time frame they have to be invested and stay in the market. So they're willing to take those ups and downs. But as we get older, just like our investment portfolio, sometimes we start to get a little bit more conservative. So we'll see clients as they're nearing retirement or in early retirement years, they're going to be gravitating more towards the UL approaches. There's even a subset category of UL which we call guaranteed UL, and it's kind of like having that condo. You don't have all of the bells and whistles of owning a house, but you do have a fixed price and you have a place to live. But there's not a lot of things you can't sublet it, you can't rent it out, you can't kind of do a lot of those extra things. But it's simple and straightforward. So Universal Life offers a guaranteed premium, guaranteed death benefit, and not much more. So it really depends on where the client is in their life and what they're trying to accomplish. If it's more guarantee and death benefit driven, or if it's more accumulation using life insurance for the other reasons that people buy it, reasons. And then there's always all the stuff in between. So as with any client, it's always comes down to a detailed conversation, needs analysis, figuring out what the goals are, what the strategy is, and then coming up with an approach that makes the most sense for them.
Yeah, maybe walk through a little bit about, through some of the different tax benefits, because, some of the things that you hear out there is you buy term and invest the difference. What are some
Mm-hmm.
of the tax benefits to doing these different types of permanent insurance policies and some of the maybe the internal benefits on the cash value side, if you could walk through that.
Sure. Um, so when we get into the different benefits, we like to call them, living benefits of life insurance. So as it sounds, you don't have to die in order to be able to tap into it. And with permanent insurance, it gives you the optionality to do other things with it while you're alive for your own needs. We like to call those, some hedging strategies. So the first one you're alluding to is taxes, right? So what kind of tax hedging does life insurance provide? Well, first we have to talk about taxes in general at first. There's a couple of ways that we are all taxed, right? There's either pre-tax, which is considered qualified money. There's taxable, which is something that gets taxed every year as you earn money on it. And then there's tax advantaged products. So many people are familiar with the pre-tax, their 401k or an IRA, and you get to push money into it and save money. So it helps to lower your current income, but it grows tax deferred. And then when you pull it out, it's 100% taxable. So we call that taxing the harvest, not the seed. Then we have taxable. That taxable camp is really, everyday things that you have in your life. It's your savings account, your CDs at the bank, your E-Trade account. As you're making money, you're getting 1099s from a bank, and they're saying, hey, this is the interest you earn. You got to owe a little bit of tax. Now, tax advantaged is the most unique of the categories. It's the least understood or the least gets notability. So there's really three products in that camp of tax advantaged. You have triple tax-free muni bonds, you have Roth IRAs, and you have life insurance. Now, the way that works is you pay into it with after-tax dollars. So your income has already been taxed. It gets to grow tax deferred. So as it's compounding and growing, it's not being taxed. And then you have the ability to extract it tax-free. And that's the unique advantage that life insurance, falls into in that category. Now, a lot of people are familiar with Roth IRAs, but not everybody has the ability to contribute to Roth IRAs. They might make too much money for one reason, or they'd like to put a lot of money into a Roth IRA, but they're capped annually on how much they can put into it. Triple tax-free muni bonds, while they are tax advantaged, they are not offering a lot of growth. So there is a level of possible instability with those, and also the lack of growth. So kind of hamstrings them just a little bit. Now, life insurance is unique in that you're not limited on how much you can put away every year. You're only limited by how much insurance you're able to afford and how much insurance you're able to be qualified for. Now, the government recognizes how important life insurance is and the tax advantage nature of it. that they actually had to put parameters on it. It's called modified endowment contract rules, which basically, I'm not going to get into the real nitty gritty of it, but what it basically means is there has to be more death benefit than there is cash value inside of a life insurance contract. So it's still considered a life insurance policy, but it is not evading or avoiding taxes altogether. In the late 80s, they had to put those limits into play because people were using life insurance as tax sheltered vehicles with extra large amounts of cash value and very small death benefits. The government said, wait a second, this is a little bit abusive. So when we're looking to save money for alternate reasons like tax hedging, in the future, we'll put in what we call the maximum non-MEC amount of life insurance in place. So that means we put the maximum amount of cash value we can put into it without evading or avoiding the government rules, and buying as little death benefit as we possibly can. So we keep the cost down and the growth happening high. So when you're trying to tax hedge, what people will do oftentimes is in any given year when they're taking in a really good amount of income and they see that they might get pushed into a new tax bracket, a next bracket up, to avoid going into that next bracket, maybe they'll stop withdrawing money from their investments, their 401ks, their investment accounts, and they'll go over to their life insurance and take a little bit from the life insurance just to mitigate their tax bracket. And that's tax hedging.
Yeah, it gives you a lot of flexibility. And I think one of the points Ben hit on, I like to look at it from a hierarchy. You should always be focusing on your 401ks or your IRAs first, because those are going to give you the tax deduction. Once you've taken advantage of those buckets, that's when you can look into some of these tax advantage vehicles for that tax deferral. So, if you're sitting there talking to some advisor and first thing he says is don't do your 401k, do a life insurance product, run and run as far away as you can. We're a firm believer of first you want to do is cover those buckets, then you look at the tax advantageous buckets. But before you get there, you got to solve to figure out how much insurance you need. And I think that's really probably the most important thing, because once you can solve for that, then you can determine the types of structures you want to have. So you may end up saying, okay, I need $1 million insurance, but I can only afford, $100 a month. Well, in that scenario, we want to make sure you cover the insurance amount first, and then you work into the permanent in the future. So more likely you'd be looking at these products if you came to me and said, hey, Carl, I have an extra $500 a month. I'm already saving. I've already maxed out my retirement accounts. I'm saving a little bit. I already have an emergency fund covered. I'm saving a little bit into a brokerage account, but I still have extra money left over. That's when these products can be really useful for some of the reasons Ben mentioned for the tax deferral and certainly the flexibility to take on tax-free income. So I think a lot of times when I meet with folks, it's being sold incorrectly as this purely supercharged investment. While it can be, there's other structures that are a little bit better initially. And that brings me into probably one of the hardest questions. How does one figure out how much insurance you need? Walk
Mhm.
us through, that process that you guys use to kind of determine, whether it's, needs based or amount based. How do you
Mhm.
guys?
Mhm. Well, the best way to figure out how much insurance is appropriate is to have an insurance needs analysis done. We call it a life insurance needs calculator. That's something that obviously you work with on all of your clients, Carl. And then a good financial advisor would be using a needs analysis. But what goes into it is essentially um, somebody walking through with you. Let's start with your debts. What do your debts look like? Do you want those debts paid off if you're not here? Debts could be, mortgages, credit cards, car loans, student loans, things of that nature. Do you want those, taken care of, paid off at your death? Next level is college. How many kids do we have? Do we plan on sending them to college? Do we plan on paying the full ride for them or a portion of it? Are we talking in public or are we talking private? And then we put the right factors on there, build that out. Then we talk about income replacement above and beyond that. Is there a need for an ongoing income replacement amount for a specified number of years? I'll give you an example. Husband and wife, you have a stay at home spouse. Maybe they're disabled. Maybe they're a caretaker. Maybe they're a homemaker. Maybe they don't have a second job or a job, and their job is in the house. So there will be a level of long-term income needed for 20, 30, 40 years. So once we've factored in the income need replacement, then we look at final expenses. Was it burial and was that going to cost us? And then do we have offsetting factors? Do we have life insurance on the job? Do we have a life insurance that mom or dad gave to us? And once we've done all the calculations, it's going to come up with an odd number, right? So it could look like $1,475,000. Then we get into the discussions of types of insurance. There's
Yeah.
term and there's perm. We do the education. Then we look into the ancillary or the other reasons why people would want to buy permanent insurance or have some of it in their portfolio. And then it really backs into budget. So in a perfect world, hey, we'd all buy permanent insurance with lots of cash value and have all these wonderful things that it can do for us. But then there's the reality world. What does that actually cost? Does it make sense to do that if I'm not even maxing out my 401k, to Carl's point? So we'll typically come up with some kind of blend. There's also some additional reasons people buy permanent insurance that we haven't touched on. I don't know if you want to get into that right now.
Yeah, we can start. One thing I'd probably add, I mean, one of the ballpark numbers I used to get when I would go through the financial planning classes, they always talked about looking at 10 to 15 times salary. Now, that number sounds pretty substantial, but Ben hit on one of the biggest areas you have to replace. If you're trying to replace 60% of your income, let's just say you make $100,000 a year, well, that's $60,000. And if you try to do that over the next 20 years, very easy for that number to start growing pretty substantially. So, and obviously, if you're making more income, that multiplies even further. So it's not, it's not unforeseen to get into those numbers where, even if you're making 100, 200 grand, that you need $1 million or $2 million of life insurance. And that number certainly can compound, the higher your level of income or higher level of your assets, which I'll use that to transition. Let's talk a little bit about more in the kind of advanced market, or maybe for some of the folks in that high net worth. And I have this sometimes that comes up, well, hey, I have $10 million in net worth, $20 million. I don't need life insurance. I'm taken care of. Why
Mhm.
don't you walk through, how they should be thinking about life insurance as a tool and an asset class that can make it a lot more effective for them.
Sure. So, as we age, and the whole goal obviously is to accumulate more assets, to leave the next generation off in a better position or a better place that we came in.
Yep.
That's kind of the fundamental American dream, and the wealthy definitely use life insurance as a tool in their arsenal. One of the main reasons that they're going to incorporate some permanent life insurance is potential for estate taxes, right? So estate taxes, or we also call them death taxes, those are taxes that you pay to the government, if you have a certain level of wealth, and they're going to tap into a percentage of that, when you pass on before the next generation gets it. The problem with estate taxes is it's a moving target. It has always been a moving target. The numbers, right now are rather high. They could go down, as they always have. They've gone up and down and up and down. And we like to say people don't know what their political life expectancy is. So which party will be in favor? Will it be Democrat? Will it be Republican? Will it be some other party when you die 20, 30, 40 years from now? And what will their view on estate taxes be? Will they be against it or for it? So many wealthy clients prepare by having some form of life insurance, which again is, well, I don't know if we even mentioned this, but it's always tax free when it goes to the family. The death benefit proceeds are always tax free. And what the wealthy will do is they will buy, purchase, and own life insurance inside of an irrevocable life insurance trust, which is actually not part of your estate. Now it's outside of your estate and it's tax free, available to the family. Number one, you would assume, it helps to pay for taxes if there was any taxes due. But there's other reasons. It creates liquidity, right? Because a lot of people's wealth is not just in cash, but it's real estate. non-marketable securities, closely held business interests with multiple partners. So it's not easy to unwind some of these assets that we have. And if we had to come up with estate taxes, then we'd have to start liquidating some of these illiquid assets. And that's where the term fire sale comes from. Having to, scramble to sell something off at a cheap discount or a deep discount just to pay for something or pay for taxes. It also creates estate equalization. And this is actually probably more often used than people realize. But estate equalization, what does that mean? Well, if you have a parent that owns a business, may have three children, the odds that all three children are going to be involved in that business when they grow up at the same exact level with the same exact commitment style, it's pretty small. So oftentimes, a parent will leave a business to one or two of the children, but they'll leave insurance to another. Or there's a second home down by the shore. One child lives in Hong Kong, the other one lives close. It becomes contentious with families. So to keep the contentious relationship from happening, they'll create life insurance to kind of equalize estate and assets to the next generation. So those are like two of the main or the big reasons that wealthy people will look at it.
You reminded me of another point. When we're talking kind of trust planning. I know something, a lot of families, in some cases deal with are special needs situations. Can you walk
Mhm.
us through some of the strategies and advantages of, life insurance and trust planning when it comes to those situations?
Absolutely. For starters, when you're dealing with a child or an adult child with special needs, it goes back to the fundamental in which we started with. The reason that we buy life insurance is because of our human life value. So if there's a parent who is routinely generating $100,000 of income, well, that $100,000 of income comes into the household, pays for the bills, the lights, the food, and most, with it regards to a special needs child, all of their care, from soup to nuts for the most part. So to be able to make sure that income continues for the next 50, 60 years is critical for people with special needs. And life insurance is the best possible asset class to use because of the maximum amount of leverage for the dollars that you pay and the benefit that you will receive in the future. There is nothing that comes close to life insurance as the tool to generate that. So typically what we would do is figure out the income need and for how long, back into a number of how much insurance that looks like. We'll purchase, typically permanent insurance. Oftentimes, to save on the cost or to keep the cost down, we'll do what we call a second to die life insurance contract on a husband and a wife. And then
Why is
we'll
that less expensive? Why don't you highlight why it's less expensive for the second to die in the death?
Sure. As it sounds, it's only paid out on the second death. So on the death of the first insured, there is no payout yet. But when the second insured passes away, then there would be a payout. So instead of owning $2 million contracts on a husband and a wife, they're absolutely going to be paying that out at some point. But when the wife dies, they have to pay out $1 million. And then the husband dies a couple of years later, then they got to pay out another $1 million. Well, in a second to die scenario, they don't have to pay out the $2 million until they both die. So
Mhm.
the length of time that is going to happen when they have to make that payout is going to be pushed out. And they know that. And that's why it costs less money, in simple terms. But getting back to your special needs planning, it's usually trust owned. And the other advantages to doing special needs planning is because it creates a defined plan of action with the benefits to put it into force or put it into play. And it preserves, again, family structure. So go to the family unit where there's three children. So there's two adult children that are perfectly healthy and leading their lives with their own families. They're raising children and college and all that fun, after school activities, but they have a sibling that has special needs. Now, if it was left to them to take care of that person monetarily, and emotionally and physically, it could be a drain that could really tear apart a family. So it's a kindness to the other children as well.
We've jumped around a little bit about some different types of strategies. Here we highlighted, providing, funds for, special needs, estate planning. One of the topics we've had conversation on more recently is having a way to have a basically replace an IRA asset. So I wanted you to maybe walk through one strategy we've worked with some other families on the IRA maximization. Wouldn't mind walking through what that looks like, just because now taxes and with IRAs, you having to take out all the money within 10 years, they're not as favorable from a kind of tax planning and an inheritance purpose. So if you wouldn't mind just walking through the IRA maximization strategy for the folks.
Absolutely. So, I want to touch on something that Carl started with before. We're big proponents of 401k. Absolutely maximize your 401k. If your employer is contributing to it, that's free money. So you never want to miss out on doing your 401k. And it's wonderful because it helps lower your tax bracket today, and it's a forced savings at that point. So they're beautiful, but the 401k, IRA, they all fall under the camp of qualified money. Qualified money was basically offered to citizens of the United States to help them with a behavior of forcing them to put money away for themselves. There used to be pensions, a lot more pensions in this country. People would work at a factory, work at a company, they'd do their 20, 30 years, and then they would get a pension for the rest of their life. And the people actually collecting on Social Security was not that great. It wasn't that massive of a burden to the government. But the pension started to dwindle. We started to live longer. The burden on our Social Security system became greater and greater and greater. So they offered us qualified funds as a way to change our behavior pattern and to save for ourselves. Now, why do I say all this? The purpose of it was for us to save that money and then use it for ourselves to live off of in retirement and have a good lifestyle and make sure that we had plenty of income coming in while we were retired. Now, the reality is people are now saving really well, actually phenomenally well, and then they're not needing all of their 401k or their qualified money or their IRA money in retirement. And the government is saying, well, now we're going to force you, and it's called required minimum distributions. We're going to force you to take some of it. And then they came one step further and said, okay, we have to do something about it. And they came out with the Secure Act. It happened a couple of years back, pretty much in the middle of the night, and wasn't given a lot of notoriety. But to Carl's point, one of the things that came out of it was you can pass the money on to your children, that's fine, but they can't stretch the income out for the rest of their life and take the tax bite a little bit every year. Now they must withdraw the entire amount within 10 years, all of it. So what happens is not only is that money 100% taxable, but it could potentially raise the tax bracket of your adult child who might be somewhere between 40 and 70 years old. So it could actually get double whammy on the tax side of it. So IRA Max is a strategy of using some of those assets, those qualified monies today. And what we do is we're showing people how to utilize the qualified money to maximize your income need, to maximize your insurance protection need, and then to leverage your legacy desire with maybe some life insurance. It's better to pay the tax now, as you're possibly in a lower tax bracket when you're in your 70s than your adult child who's in their highest earning years, and to take the net proceeds of that, buy some life insurance, maybe even put it in a trust outside of your estate, and actually maximize the leverage that you're giving to your children. There's one other point I want to make on that, and that's a little thing called step up in basis. So the government is giving us, all of us, something called step up in basis. So you can take your house that's worth $1 million today. If you passed away and gave it to your child tomorrow, your child's cost basis is $1 million. And if they sold it for $1 million and $1 million, $1, they would have tax on that $1. That's a huge opportunity benefit for your children. Your brokerage account, your CDs, your money markets, your house, your car, your collectibles, it's all given a step up in basis. Those are the type of things you want to give to your children at death. Instead, what people are doing is they're putting all these things in trusts and joint title ownerships with their children. They're throwing away their step up in basis, and then they're giving them this qualified money as the legacy, which is absolutely walloped. So we're trying to help clients work with our clients to kind of change that structure a little bit and show them how to maximize what they leave behind on the step up side, minimize what they leave behind on the qualified side while maximizing their current income. Because first and foremost, let's have a solid income in retirement. Let's make sure we have enough insurances like long-term care to protect our assets. And then let's have enough legacy to really create that family wealth that you're trying to do.
Now, we've hit a lot on the individual strategies. Let's talk a little bit about business owners. What are some of the some of the reasons why they may look at insurance and some of the different types in that space? Because obviously that's a whole different type of vertical.
Yep. So there's a lot of things that business owners need life insurance for, but we'll go through some of the fundamental basics of them. The first is when there's multiple business owners. So Carl, you and I, we own a business together. We started this restaurant from scratch and our own, sweat equity and tears. Thankfully, it's worth $1 million right now. Now, if I were to pass away, I know for sure you wouldn't want to be in business with my wife, and vice versa. What you'd want after you've done grieving me is you'd want to be able to buy out my wife, choose your own partner, choose not to have a partner, but you'd want to be able to continue with the business, continue with your retirement strategies, using this business as your retirement strategies, and not have to worry about my family and paying them, a heavy salary that's dragging you down without getting any participation. Why am I explaining this? This is called a buy-sell agreement. So we come up with a buy-sell agreement that says, I'm going to buy your family out for this amount of money, and you're going to buy my family out for this amount of money. We have a legal contract drawn up with an attorney, and that's the stipulations of our buy-sell. Then we use life insurance to fund it. So I own a contract on you and you own a contract on me. That's the funding mechanism to fund the buyout. Now we have a happy accord. There's no concerns about, God forbid, something happening to one of us and then destroying the other partner's, ability to keep the business. That's the first one, probably the biggest one. Then you get into key person insurance. So key person insurance is insurance that's purchased on a key person. You can call them a key person. You can call them an important person. You can call them the rainmaker, your right hand, your most important employee. So a lot of times businesses will purchase insurance on their key employee to protect against death, right? God forbid they were to pass away prematurely. What would happen if the rainmaker or the gal or the guy, or the gentleman that gets everything done to make this business as profitable as it is? So that's one way they use key person, but they also use key person as a golden handcuff. So what if that key person doesn't die? They actually leave and go to a competitor. How do we protect ourselves, our businesses from, our best talent just walking out the door for a 10% raise? Well, golden handcuffs are when we purchase permanent life insurance for that executive that's cash value rich. But we put stipulations on it like, hey, this is yours and I'm going to pay for this for the next 15 years, but you got to stay with me. And in the 15th year, I'm going to turn this over to you. It's going to be all yours. So that's a real, benefit for somebody to walk away from, and it creates some real stickiness. And that's why in our business we call it a golden handcuff for an executive. So those are, two big examples, but it's also used for succession planning. If I'm going to bring in my young protege, but I want to make sure that I'm protecting him if I should prematurely die, that he's got the capital to continue going forward and learning the craft. So there's just so many reasons why businesses, tap into insurance. Those are just some of the highlighted ones.
Yeah, I mean, I think the overall theme here is planning, right? You want to have a plan, whether it's for your business or for your family, to make sure that they're protected. Because one thing we know is you will pass away at some point, but we certainly don't know when, right? So that's the one thing we can't plan for. Obviously, I have questions like, well, what if I live to 100 or I live to 80 and I want to do a policy that only covers me 85? Again, if we had a crystal ball, it'd be a much different scenario. So, one of the things I want everyone to take away from this is make sure you've at least done a review of your situation. I know when I first got in the business, I had a friend of mine from high school who passed away, in his early 20s and had three kids, and he had no insurance. So you see that, and I'm sure many of you guys listen to the call. There's been a scenario within, your extended family, friends, et cetera, where that has happened. And nowadays you can get these policies on the term side for such low cost. If you're young, you might be able to get a term policy for like 10 or $20 a month. So, for that peace of mind, we always recommend to go out there and at least get something in place. If there are people within your family you're trying to protect, especially as loved ones. Ben's a resource. I'm a resource for any of you guys listening today. Let us know how we can help. We're glad to go through that needs analysis process, help you analyze the different types because we do know it's very confusing out there. But just know you guys do have resources. So with that, I wanted to, once again, thank Ben for his time. Today was really helpful, and I'm sure all the listeners will agree. So Ben, thanks so much for the opportunity to learn about life insurance today.
Thanks for having me, Carl. Great being here. Thank you.
Appreciate everyone. Thank you.